Hello everybody, it's Yashar here, back again with another video. And in this video, I will cover EQB earnings report which released last night after the closing bell. I will also update my valuation of EQB stock with the new discounted cash flow calculator and the new financial data we received yesterday. EQB at the moment is up almost 5% after this earnings report, so I guess market really liked the numbers in this report. There's a lot to cover today, so let's jump right into this. EQB is one of the largest holdings in my stocks portfolio. In fact, it is the second largest company I currently hold after Aritzia. I personally have 200 shares of EQB inside my TFSA, and I really think this is one of my investments that will significantly outperform the market in the coming years. For those of you who are not familiar with EQB is the 7th largest Canadian bank by market cap and is a fast-growing digital bank and a competitor for conventional banks in Canada. They increased their number of customers by double digits each year, gaining more and more market share from conventional banks, and as a result, they were able to grow their deposits pretty fast in the last couple of years, which in turn was the main driver for their revenue growth. As you can see here, they increased their revenue consistently in the last 5 years. They basically doubled their revenue in this time frame. Similar to revenue, their bottom line adjusted diluted earnings per share also increased consistently and almost doubled in the last 5 years. The return on equity was consistent between 12% and 16% during the last few years, and it actually hits a new all-time high just in this quarter at 16.9%, which demonstrates the quality of their business in turning capital to profit. And their net interest margin, which is one of the most important profitability metrics for bank stocks, grew consistently quarter after quarter and year after year, and it is now at 1.92%. And it is improving each year, which demonstrates how profitable this bank is with their loan products like mortgages and line of credits. So they are growing their revenue and their profit margin at the same time, which is great. In addition to these fundamental metrics, they consistently increase their dividend, particularly in the last 3 years, by over 20% year over year and almost 6 to 7% quarter over quarter, while they maintain a very, very low payout ratio under 15%, which guarantee you that these dividends are pretty safe. After going over fundamentals, let's shift the focus to the recent earnings. The company reported their earnings yesterday after the closing bell, and I think it's an overall great earnings report with some amazing numbers regarding their core business, the growth of their deposits, the number of their customers, their plan for expansion in Quebec, and also their dividend increases, which all are great news for investors. Let's review the earnings report highlights. Adjusted Q1 revenue is up 40% year over year. Adjusted Q1 net interest income is up 45% year over year. Their net interest margin is up to 1.92% or up 9 basis points year over year. EQB customers up 26% year over year, and deposits are up 12% year over year. Their adjusted Q1 return on equity is 16.9%, which is, I believe, an all-time high for the company. And in terms of the risk management, their total capital ratio is 15.5% with a CET1 ratio at 14%. CET1 ratio basically compares a bank's capital against its risk-weighted assets to determine its ability to withstand financial distress, and 14 is much higher than the minimum requirements for a bank in Canada. They increased their dividend yet again by 6% quarter over quarter or 28% year over year. They basically continue to increase their dividend every single quarter by 6 or 7%. The EQB dividend yield on cost for shareholders will be ridiculously high in the next 3 to 5 years if they can continue to increase it like this. All in all, solid numbers across the board. I'm happy with the core business performance and will continue to hold my shares in EQB for the years to come. Now, let's use the updated financial information from this report and plug them into my new discounted cash flow calculator and find the fair value of the stock. To start building the model, I imported a series of general parameters from EQB earnings report, like the current share price, the revenue, the number of shares, their net debt, which is their short-term and long-term liabilities, minus their cash or cash equivalents, and their adjusted diluted earnings per share. I also put my expected rate of return to be 12.5% for this stock to give myself a little bit margin of safety. Now, in this model, I will calculate the fair value of the stock by projecting their future earnings and then discount the terminal value and future cash flows minus the liabilities of the company back into the present value of the stock based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. I consider them to dilute you to raise capital by 5% and have almost 10% share-based compensation to reward executives and employees during this time. And they will be able to grow the revenue by 7% in the short term, 6% in the midterm, and eventually by only 5% in the long term. And I consider the terminal multiple of 6, which is in agreement with historical bear periods of this stock. For the base case or normal case, I considered a little bit better margins in line with their historical average, a bit better revenue growth, and also lower amount of share dilution, and a terminal multiple of 7, which is historically an average multiple for a similar bank stock. Finally, in the bull case, or the best possible outcome, I considered a little bit better profit margin, or a margin expansion, only 4% share-based compensation, a 15% short-term, 12.5% midterm, and 10% long-term growth, and a terminal multiple of 8, which is a bull multiple for this company. Now, if I hit calculate, the software will give me some valuable information about the stock based on my assumptions. It gives you the intrinsic value of the stock in each scenario, and then it will provide you with a fair value estimate, which is around $72 per share for EQ Bank. And comparing to the current share price, EQ Bank trades at 16% discount today. It is a buy according to this model. There you are, guys. I hope you enjoyed the video. If you enjoyed the video and my coverage of earnings report of Canadian companies, consider subscribing to the channel to see similar videos. I will wait for my other Canadian companies earnings report to hopefully cover those as well. But until that time, I see you guys in the next video. Farewell.